Welcome to 3 Minute Tech. These are the videos where we answer your technical financial planning questions without all of that jargon. Shot on location at our beautiful new offices, Level 37 QV1. Today we'll be talking about Division 293 tax. Now for those who know what this is, I can already feel the shudder coming through the screen. But for those who are not familiar with it, we'll be talking about what it is, who it applies to, and what we can do about it. Now, what is Division 293 tax? Well, Division 293 tax is an additional 15% tax that applies on concessional contributions. So the question you might have, what are concessional contributions again? Well, that's the 11% super guarantee contribution that your employer pays. It's salary sacrifice contributions, or it's tax deductible contributions. Now these are ordinarily taxed at 15%, but if you're levied with Division 293, that increases by another 15% all the way up to 30%. So who does the Division 293 tax apply to? Well, this applies to anyone who has adjusted taxable income above $250,000. Now this income definition includes your taxable income, reportable fringe benefits, net investment losses, rental losses, family trust distributions and concessional contributions. It was introduced many years ago as a means to equalise the tax benefits that people get for concessional contributions. So the question you might have is, with this additional tax, do contributions, and concessional contributions in particular, still make sense to super? Well, asking a financial planner if contributions to superannuation is much like asking your hairdresser if you need a haircut. The answer is inevitably yes. But in this case, let me prove it to you. As we can see on screen, the tax benefits you get from making concessional contributions to superannuation are significant regardless of what tax bracket you are. But if you're earning above $250,000, the tax benefit you're getting from such contributions are only 17%. You compare this to someone earning between $180,000 and $250,000, they get a 32% tax benefit from making these contributions. For someone earning between $120,000 and $180,000, that tax benefit is 24%. So the answer is yes, it still makes sense, but it's important to look at your situation for any other opportunities as well. So if you receive a Division 293 notice, what can you do? Well, this notice is levied by the ATO after you've completed your personal tax return. So once they've been able to verify that your earnings are above $250,000. You'll be levied with a notice, and you can either have it paid from superannuation or pay it from your personal tax flow. If you pay it from superannuation, you have to make a release within 60 days of the notice. How do you do it? Well, it's as simple as either speaking to your tax agent or simply logging on to your own MyGov portal. So are there any strategic considerations to be had with Division 293 tax? Well, unfortunately, the government has closed a lot of the loopholes. When determining your income, negative gearing is factored in, and so is deductible contributions to superannuation. Therefore, the only way to get your income down are things like self-education expenses, donations, or prepaying things like income protection payments. But in your circumstances, it may not make sense to simply bring these expenses forward, and therefore it's important to consider what you're doing and what you're trying to achieve. Equally, what you may look to do is, when you're making that additional marginal dollar of concessional contributions to super, is it beneficial to be making it in a spouse's name who may not be paying the Division 293 tax themselves? Like we went through on that previous table, there are different benefits based on different marginal tax tiers, and therefore it's important to consider that as well. So in today's case study, we have Samantha. Samantha earns $225,000 and gets concessional contributions into a super of $24,750. Now, based on those income numbers, she is not liable to pay any Division 293 tax. But what if we assume she also received $10,000 of interest external to her employment income? Well, in this instance, yes, she would go above the $250,000 threshold, albeit marginally, and therefore need to pay Division 293 tax of $1,463. So what have we learnt today? Well, we know Division 293 tax applies to someone who has income above $250,000. And unfortunately, the income definition factors things in like negative gearing and deductible contributions to super. Now, this tax isn't levied when you make the contribution, it's levied when you actually lodge your ATO personal income tax return. When you get that, it's important to consider whether you pay it personally or whether you pay it within superannuation as well.